All right, so folks, good afternoon. Good to have you guys here again. Sorry to be late. I left earlier than usual and came back later than usual. So I guess that's just a function of carnival traffic, right? But let's see if we can kind of get into the meat of it. Let me just let Matthias. Hey Matthias, afternoon. How you doing? Good to have you on. All right, we're not going to start so you're not late at all. Okay. Cool. All right, folks. So last day we met, we were looking at the balance sheet again, and we took a look at the net asset version of the balance sheet, and we said that this was helpful where they didn't give you capital and you had to kind of calculate capital. All right. So you would do in order of permanence in your non-current assets first, followed by current. You add them together and get total assets, and you have your non-current liabilities followed by current. Add them together and get total liabilities, and then you subtract 200 minus 80 is 120. And then that is just plugged in as a capital figure. Just give me 1 second. Let me see where dog is barking. Yeah, guys. Let's proceed. Right. Right. And then we talked about, we did a question after that. So what we did is we looked at the 2-column format, right? Which gave us, again, this column here. So like the workings or the details for each of the items in each of the sections. And then when you shift one space to the right, you get your total or subtotal for that section, right? And it kind of stayed consistent. The only thing was when it came to do the net assets, you had to remember that it was total assets, then minus total liabilities. All right. Now, the 3-column format kind of overcomes that issue. All right. So you'll have your non-current assets, the subtotal, current assets, subtotal, and then total assets off to the extreme right in a 3rd column. Right. For non-current liabilities, current liabilities, same thing. Details here, subtotals here, and then grand total for that section. And then the 200 minus the 90 is a bit more easily seen. Sorry, I think I forgot a 0 here. Yeah. Right, and again, the capital is just simply put in at the very bottom there. That chair is squeaking, I might want to swap it out. So the chair is squeaking, I might want to swap it out. Right, and then we took a look at the working capital format. Now, I'm seeing that we only have an example, right? So we talked about what working capital is, right? So let's just zoom in here real quick, just to do a brief recap. So it is literally the difference between current assets and current liabilities. And it is considered an important item in terms of liquidity. Oh, here's Talia, sorry. All right. Hey, good afternoon, Talia. How are you doing? Good to have you on. All right, yeah. Don't worry, you didn't miss too much. I'm still doing your recap. I started very, very late today. Yeah. Let me just put something on the roll here. All right. Shiraz watches the replays, right? Teresa will come on a Wednesday. Sorry, I'm just seeing some gaps in this. Okay, so we missed out 5 people. So Aisha was here, and she just kind of jumped out. Okay, well, hopefully she comes back sooner rather than later. Right. So, like I was saying, right. So this it says that this item, the net working capital, must be shown explicitly in the body of the statement, right? So again, just to give an idea of the liquidity of the entity or the ability of the entity to repay its current liabilities with its current assets. All right. Now, right. So it kind of sort of upends the order of permanence and order of liquidity. But as we know, there's no one right way to prepare a balance sheet. Okay. So what I did, as you can see here, I said it should be noted that this is, in my opinion, the least intuitive way to present the balance sheet, right? Because we said a balance sheet is supposed to show the resources of the business, the assets, and how those assets were financed. Where did the money to buy the assets come from? It would have come from the capital as well as the liabilities. So either the owner or entities other than the owner, right? And of course, we have the classifications of current and non-current. Non-current being longer lasting assets, and current being the more liquid of the assets, the ones that are converted to cash or used up within 1 year or less. All right. So in this particular 3-column version, you could see, like I said, the consistency in terms of what goes where kind of takes a hit, because you could see we start off with the non-current assets in the middle column, with the subtotal being, or the total for that section being in the right. And then for current assets, it starts off in the leftmost column with the subtotal being in the middle. And then same thing for current liabilities. So there's a bit of consistency here. So this one seems almost like the outer place one, because we want to do 70 minus 30 equal to 40. And of course, is then 130 plus that 40 is 170. And then you subtract your non-current liabilities. And then you put your capital section. All right. Right. So, in this particular case, we had the net asset presentation where we had all of the assets together minus all of the liabilities together, and then your capital down here. However, there is something called the long-term financing approach to the balance sheet, which will, the major difference is the placement of the non-current liabilities. As you can see on the top side of it, we have non-current assets. Then we have current assets minus current liabilities, giving us net working capital, which is then added to non-current assets here, right? And then we have the capital, 120, and then the non-current liabilities being added together, right? And again, it's called the long-term financing because it shows the two items that are kind of the two sources of finance that are going to kind of be in the business for a long time, right? The capital is going to be there almost indefinitely. There's no set date by which the owner will take out his or her capital or by which it has to be repaid, hence long-term, right? And then for the non-current liabilities, as you can see, it's 10 years. So it's going to be there for quite some time. All right, so this is where we kind of ended on Monday. So what we need to do, of course, is practice a couple versions of this. But what I'm going to do, right, so in class, people, you guys met the working capital format in school, I would take it, right? Here's my question. Where were you shown to put the non-current liabilities? Were you shown to put it on top with the rest of everything and have capital by itself? Or were you shown to put it with capital down here? On top? So like a net asset approach, right? Okay, all right, cool. And what about Google Meet, right? So my online people, what about you? Give me a T if you showed your non-current on top and a B if you showed it below, right? Or if you were shown both places, just put a 2. Right? So if you wish non-current, yeah. So okay, so you're putting non-current liabilities with the capital. Okay, cool. Right. Google Meet. Go ahead, man. Oh, on the top. Okay, cool. Right. So you're took more of a net asset approach. All right, lovely. Kenny, how you doing? Good afternoon. Good to see you. Penguin, Maya, Cara, how you all doing? Afternoon. Right. So Logan says below. All right, so the majority of y'all, it was at the top. All right, let me just get some water. Okay, so what I will have you do is I'll give you some information, and what you will do is you will then produce a balance sheet showing the working capital explicitly, and you can put in the non-current liabilities wherever you want to put it, or wherever you are accustomed putting, right? For who? No, I don't have that. Oh, you don't have phone number? Okay, I think I have phone number. All right, so I'll message you and tell her. You told everybody else, right? All right, just give me 1 sec, guys. Yeah, she straightened it. Yeah. Yeah. Sorry, guys. Just have send a quick message. Carnival has caused some changes in our little schedule here, right? Okay, cool. So, let me go on to the other page here. So this is the working capital review question. All right, so we could take out the what you call it. All right, so the RQ. What's going on with this mouse boy? Right, okay, so the RQ. Yeah, let's go with the Yamada. Oh, I know what I'll do. Right, so we'll actually use the same what you call it, information for the previous question again. Oh my god, this thing is annoying. Okay. All right, so this is your question here. Let's zoom out a little bit. So you have to do a balance sheet. So again, it's the same information as the previous question, not the example, the question. I'm gonna send it in the chat as well. Let me see if I have to send any formats in the chat too. All right, so I just sent the question. Right, the two formats are also in the chat. Okay, cool. Right, so after we do this one and possibly the next one, what we'll do is we'll start looking at some of the items to be included in the current assets section, such as the provision for bad debts, accrued revenue, prepaid expenses, that sort of stuff. Current liabilities, we will probably also take a look at. Right, I'll try not to give too many definitions today, but if you all want it, I'll give it. Right, right. So this is your work you're doing now. Who needs a format for the balance sheet to work in? Are you all working in the books? Yeah. All right. Okay. How many columns do you want? 2 or 3? All right. I'll do 3. All right. Hey, Mandeep, how you doing? Give me 1 second. All right. All organized. Two, four, three. All right. Yeah, no problem, Mandeep. I start too long, you know. I didn't even 50 minutes to the class yet, so you miss much. You miss the recap. And we're gonna do a balance sheet now with the working capital format. Right? I did the example last time. I just kind of recapped it. So, right. Okay. Cool. Let's go back in here then. Right. So that's the information there. So prep that balance sheet. Correct. Jest Uzumaki Naruto. Atake Kakashi. We'll check for them later, right? What we're doing is the same information, but we're doing a different format. We're doing it working capital format now. Right? We just did the working capital example last class, so we recapped it. So you're doing the working capital now. Legal. All right. Let's starting. So let's zoom out to about 160 is fine. Mata. Oh, maybe I actually could no. Yeah. Hold on. Wow. A rank amateur using one spreadsheet. Let me say 60. How about that? Okay, cool. All right. So we can do that. Let's put this split back. Yeah. Okay, right. So we're going to start with the non-current assets. What are the two non-current assets we have, ladies and gents? Fixtures and furniture. Right. So we're going to start there. So we have non-current assets. So we have fixtures, right? Value there. Now we're doing the working capital format. Now, even if you want to put the non-current in this column, that's fine. I just don't, right? And furniture, our 68,000. Add those two together, get a total for non-current assets. Okay, all right, then we have current assets. All right, Marcus, what are the two current assets we have? Inventory and cash at bank. Okay, so for those, we're going to shift to the leftmost number column. We're going to put 50,000 there and 10,000 there. 50 and 10, of course, will give us 60. There's no paper. Oh, look across that. Yeah, that should have. Yeah. Right, and then we're going to do less current liabilities. Okay. Okay. All right, Paige, what items there, or what item is a current liability? The current portion, right? So current portion of non-current. What's the amount of that, by the way? 30, right? Right, so now when we take the 30 from the 60, we'll get 30, right? And that is our net working capital. Right, so what do we do with that 30? We have to add it to the 140 and 130 and 140 and 30, so it'll give us 170. All right, so sorry, my head blocking. Okay, are we okay up to that point for net working capital and the figure after for 170? Ladies and gents, boys and girls, of all ages, yeah? All right. Okay, and the ladies and gents online. So Aisha, Alexis, Aliana, Ayaz, Jordan, Cassie, Liam, Logan, Mandy, Matthias, and Talia. Talia. Call you Talia, especially dance. Give me a quick genie chat if you give it that. Sorry. That was the intro. Give me a genie chat if you give it that. We have accounts payable. Oh, look at that. Thank you, Shamo. All right, sorry about that. How much is it? All right, cool. Let's fix that then. Sorry about that, guys. No. All right. Right, so 20 and 30 is 50, and 60 minus 50 is 10. And then 10 plus the 140 is 150. Right, wow. Yeah. Okay, cool. Now from here, we could do less the non-current liabilities. Right, now we only have one, right? So we have the 12-year bank loan, which is how much? Now, it was 70 in total, right? But we have a current portion with 30 payable, right? And 70 minus 30 is equal to 40,000. So now when you subtract the 40 from the 150, we're going to get 110. And that there is our net assets. Sorry. Right, so let me just go up a little bit more because I know my head blocking a little piece. Right, so sorry. Yeah, sorry guys. I didn't realize I had a mistake. My bad. Yeah, okay, never mind. Yeah, sorry. I missed out something. Hard on the test, right? Right, so up to that point, I think we should be okay. Now, all we have to say is financed by capital. Yeah, go ahead. Right, so total net assets would be the 150 minus the 40. Now, we got the 150 because that was the non-current assets, 80 and 60, giving us 140, plus the net working capital. Net working capital came from the current assets, 50 and 10 is 60, minus the current liabilities, 20 and 30 is 50. So 60 minus 50, which is current assets minus current liabilities, gives us net working capital, right? That item is added to the the non-current assets, and 140 and 10 is 150. From there now, we have the non-current liabilities to subtract if you are doing a net asset approach. And when you subtract 40 from 150, you get 110. Does that help? All right, no problem. Right, and then we have financed by, so financed by capital. Right, and you could just put the 110. Right, because we had to calculate that. Right, so capital invested by owner. Right, so I'm going to zoom out a little bit so we could see the whole balance sheet. Oh, sorry, I was doing something. Right, so this is one version of it where we have a net asset item because we did total assets 140 and 60 minus total liabilities 50 and 40. But of course, we didn't put assets together. We didn't put liabilities together because we had to show this working capital item. All right, so like I said, the working capital format is the least intuitive and the most kind of mixed up one that you'll encounter at this stage. Right, it doesn't get too much more mixed up than this. Unless you're doing all of liquidity, which you all are supposed to know how to do, but I don't know if I'll have time to do it. And I've only ever asked for it once. Anyhow, if anybody did the other version where you put your non-current liabilities below to show a long-term financing approach, right? So let me shift around some stuff here. All right, from here, I'll add and get 150, right? Now, when you are doing a long-term financing approach, you don't have net assets, right? So what's going to happen is that sorry, 1 second. This will come below here. Right. Give me 1 sec. finance by, I could take that out too. Right. And then of course, well, this will go here. I'm going to add the 110 and the 40 and get 150. Yeah, I think I will need to skip a line here. Put that one in a different color. I'll put this one in the gray so that those two things match up. All right, cool. Do I have any other lines I could take out, boy? No. All right, so 80 and 60 is 140. 50 and 10 is 60. 20 and 30 is 50. 60 take 50 gives us 10. 140 plus 10 is 150. Right? Now, there's no real label you could put here. Anyhow, but you could put total assets less current liabilities. And down here, this is capital and non-current liabilities. Right, but conventionally, we don't put these labels, right? But I will just include them so that these spaces aren't just very bare and weird looking. Because we kind of accustomed having a label for everything, right? Okay, so this is the other way that your balance sheet could have looked, right? Putting the non-current liabilities together with your capital, because those are both long-term sources of finance. Because once again, non-current liabilities are for periods of longer than 1 year. In this case, it says 12. It literally tells us how many years. And the capital invested by the owner has no defined date to be repaid. And when the owner makes the investment, it's kind of an investment for the life of the business. Doesn't mean the owner doesn't earn money as we go along. That's why they make profit, and they'll take the profit out via drawings, right? Okay. All right. So with this now, I want to put a pin in that piece there. But does anybody have any questions on either of the presentations that we just did? No? Okay. Okay. On Google Meet, just give me a quick G in the chat if you're good with what I have on the screen. If you need me to re-explain anything, that's not a problem. Just let me know. All right. Right. So what I wanted to do today primarily was I actually wanted to explain the items, like the adjustments that we do put in the current asset and current liability section. So without further ado, I'm just going to jump into that. All right. Current assets. All right, cool. 1 second. Right. Lovely. Use 40 for now. Okay. Okay. So additional current asset item. Okay, so apart from your inventory, your receivables, the cash at bank and cash in hand, we have a few more items that go in the current asset section ever so often, right? So one is the provision for bad debts, which is more correctly called the allowance for doubtful debts, right? Those are right, Jessica, because I'm going to give notes on each of these things. Actually, you know what? All right. The accrued revenue, prepaid expenses, and short sorry, 1 second. Short-term investments. All right, so as we know, the provision for bad debts or allowance for doubtful. Now, let me explain why it's actually more accurately called the allowance for doubtful debts, right? So, to me, it's been called this since I was doing PoA, and we're talking back in the late 90s, right? So, we're talking almost 30 years ago, right? As time has gone on, definitions have changed, meanings of certain things have changed. So, we have to kind of roll with the times, all right? In your CAPE level syllabus, when you're going to the accounting standards, the word provision has a very specific meaning, right? It means a liability of unknown timing and amount. Now, what does that mean? I think I may have discussed this. Was it with you already Form 4s, boy? All right, so imagine that you're in a company and you guys are caught in a lawsuit, right? And at the end of the year, you're not sure. Well, the jury hasn't ruled in favor. The judge hasn't given a ruling as to if you have to pay or if you're in the wrong or whatever the case is, right? But your lawyers tell you, hey, most likely this isn't going to go your way. And people who have sued companies for this same matter have been awarded things in the range for between $1 million and $10 million, right? Yours might be in the realm of 2.5 because of the severity of the issue, right? So the thing is, the judge hasn't ruled. Your lawyers are saying, hey, they probably will rule this way, but the judge still hasn't ruled, so it's not confirmed. But because you're lawyers, you trust your lawyers, right, to advise you on these matters. You say, hey, what? If my lawyer says so, I'm going to create this provision. I'm going to provide for this possible liability, right? So that's what a provision actually is. A liability, an amount of money you're going to have to pay, but it's of unknown timing and amount because we don't know when the judge will rule and we don't know for how much they will rule against us, right? And that's not what a provision for bad debts is. So we can't really use the same term to mean two different things. All right. And then bad debts, where again, what is a bad debt? A bad debt is money that was once owed to you, but for which you can no longer collect. Right. So this is also called uncollectible accounts. Right. So the allowance means you're literally making an allowance for it. As in, so I like to use the same term when I'm explaining what something means, right? So in other words, okay, we have two types of sales, right? We have sales, cash sales, which is where you sell goods and receive cash immediately. So whether that's any form of actual physical cash, whether they use their links card and the money is transferred to your bank, or whether it's by a credit card and you have to go through a process to get the money, those are all cash sales, right? Cash transfers almost immediately, if not. But the other type of sale is called a what? If it's not a sale for cash, it's a sale on credit. And with a credit sale, does cash transfer immediately? No, it's quite the opposite. Cash is transferred at some later point in time. It could be the very next day. It could be 1 month from then. It could be 3 months, 6 months. We hope it's not that long, right? It could be very long sometimes, depending on the nature of the situation, right? Now, so simple question. If you lend somebody, if in school somebody asks you to borrow $20, right? And you know the person and you know they'll pay you back, how likely are you to lend them? Very likely, right? So you're lending money and next 2 days you get back or by the next week or the week, right? If it's somebody you don't really know, who you don't really talk to, and they come and they ask you, oh, Alicia, thank you. Yes, very, right? If it's somebody you don't know, you never talk to, you're not in your same class and they ask you to borrow $20, or they say 40 because they had to travel home and they had to buy some lunch and they're kind of hungry. Well, if you have a good heart and you know of the person, maybe. But if you don't know this person from Adam, you're like, well, I had that kind of money on me, you know? But let's say you took a chance and you lent them, right? And as time went by, they kept kind of putting it, oh, I'll bring it for tomorrow, Eventually you get the picture, right? You'll say, well, look, I lost that money, right? Now, let's say 2 or 3 days went by, and on the 4th day, when you decide, hey, I'm not getting back that money, on the 4th day, they come and they give you $40 back. Like, oh, okay, well, thanks. So it ended up coming through, right? Now, up until the point they paid you back, you were doubtful. You were doubting that you get the money back. Can we agree? Right. Now, in that case, you would tell yourself, look, I'm not really going to get this money, so I'm going to kind of, as they say, write it off, right? Now, when you actually lose the money, that's when bad debts are written off. But I straying a bit too far from my core topic here, right? So this provision for bad debts or allowance for doubtful debts, basically what it is, so the point of talking about all that stuff is because in business, losing money on credit sales is a phenomenon. If you know somebody wasn't going to pay you back, would you lend them the money? No, right. But if you do lend somebody the money, you are assuming a risk, right? You are taking on a risk. And some risks in your mind would be very small and some will be larger, right? Same with business. They take on these risks, but of course they'll have people sign contracts promising to pay under certain conditions and along certain guidelines, whatever the case is, right? And if the people don't pay, the company can then carry the contract or the signed document to maybe a lawyer or maybe a collection agency and say, hey, this person promised to pay and they're not doing so. Can you force them to pay? And they say, all right, cool, I'm on it, right? Cool. Now, because bad debts are losing money via credit sales, or well, from receivables that came from credit sales, because losing that money is a reality, but it's a risk that we don't know when it'll happen, we have to, as accountants, create this allowance, or as they like to call it, a provision, right? It's an estimate of the value of receivables we expect to become uncollectible, right? So long story short, right? So this is an estimate of the value of receivables, that may become uncollectible. And more importantly, it is subtracted from the receivables figure in the balance sheet. Long story short. Okay, so all that to say that, right? Now, of course, I'm going to give you like a kind of layout that you could follow, right? But I want to explain you things before, right? Accrued revenue. Now, we know of accrued expense. What is an accrued expense? And I'm on the left, what? Unpaid or owing at the end of a period. So we incurred the expense. So we told somebody, hey, cut the grass somewhere. And then they're, oh wait, I don't know cash. You can pass back tomorrow. So you're owing the person money, right? Or your electricity bill, right? So if you do sort of like an automatic payment, the bill will come. And if you forget it, the company will call you or they'll send you and they'll say, hey, you're due for this connection. You have money for us. Like, right. So when something is accrued, it is unpaid. Now, we could be that entity that's providing the good of the service and didn't receive payment. Now you might say, but that's just a receivable. That's a credit sale. True, right? But there are other instances, for example, where we might classify something separate from accounts receivable or trade receivables. Let's say, for example, you were renting a piece of your property to somebody, right? And they forgot to pay you, whatever the case is. So you mightn't want to lump that in with your trade receivables, because your trade receivables are the receivables from your trading activities, your buying and reselling of goods. Whereas this little item here, the little rent, is on the side. So you don't want to kind of unnecessarily obscure or skew the value of your actual trade receivables, right? Anyhow, right. So this is any money owed to, I'll put you, right? Other than regular trade receivables. I'll put another word here, earnings, right? For example, let's say you have money in shares, right? So remember we did limited companies last year, right? And shares pay their shareholders dividends, right? So let's say the company declared a dividend and say, hey, I get some money. But until you receive it, right, until your check reaches to you, the money is owed to you. So that's another form of accrued revenue, all right? All right, prepaid expense. Okay, when something is prepaid, what does that mean? It's paid in advance, right? So this is where we pay for some expense in advance of it being incurred, right? So I have one more to put. I forgot that other one, right? Short-term investments. Right? Cash equivalence is usually a term you'll see associated when you do cash flow statements in Form 6, but I'm just putting it here now, right? Okay, so when we talk about investments, you're talking about stuff like mutual funds or index funds, or you go to the UTC and you put money in one of their money market funds or the capital market, whatever, whatever, right? But short term implies that you plan to get back the money or your interest within what period of time? 1 year or less, right? Because you could have long term investments. You'll deal that with that when you get to Form 6. But if you do have long term investments, it'll be part of your non current assets, right? So these are highly liquid vehicles in which money is stored, right? So you can see like term deposits, index funds, right? And the one I forgot was supplies. Right, so this one might seem kind of weird because like we're talking about supplies, right? So, sometimes also called inventory or stock of supplies. Right, now this one appears infrequently, but it does appear nonetheless, right? So for example, so I have printers. Well, one functional, one not so functional. So I have a printer. And for the printer to be of use, I have to have ink in it, toner in it, and I also have to have paper to print stuff on that I'll give you all to write on or to read, whatever the case is, right? Now, a box of papers, let me say, is about 350 TT, right? So if let's say on December 1st, I buy a box of 10 reams and I use out 2 reams, right? So let's say the value I have left, so that's 1/5. So let's say I have 280 worth of paper left at the end of the year, right? Now, what would happen in my current asset section, what I probably could put, or what I shall put, is I will put the value of the paper in the balance sheet in the current asset section because I intend to use that paper within a couple months' time, right? But what you should not do usually is you shouldn't just expense the whole thing, especially if you haven't used it up, right? The toner, to me, that's a different story. I'm not sure how to account for the toner other than, hey, I'm buying this. No, the toner is expensive. The toner is more than I need paper for sure. Right? That toner cost me, what it was, about 1,050. Right? So I can buy what? I can buy 3 boxes of 10 reams. I can buy 30 reams of paper for the price of one toner cartridge. Right? So yeah, maybe I should find a way to kind of account for that. Anyhow, but long story short, so these are consumables. Right, like stationary cleaning items, right, that the entity will use in the near future. So we could get into a more detailed discussion on that, but I want to actually get to the item itself, right? So what I'm going to do, let me send a picture of this text box in the chat, and then I'll show you what your current assets section could look like, and then I'll show you what your current liability section could look like. Oh, thanks, Logan, for sending that. I appreciate it. Yo. I will think about it, but it can't just be one class. Really, transformation takes about 4 classes to do. Because you have translations, you have reflections, you have rotations, and enlargements. You could potentially do 2 a class, but then to me, just be rushing it. So that's 4 sessions we can either spend on that, or yeah, it's already printed. Just have to staple it. Yeah. So is either we take 4 sessions out of the past papers and potentially lose a whole paper to do that, or we could just kind of work it in the papers as we do it. But then that also has a disadvantage of not being consistent enough or focused enough. So that's the problem. My question is, if I can do the math, so I can get You could start it whenever you want. Yeah, I mean, I just had to staple it. I have about 15 to staple, so I was supposed to staple when I give you guys stuff to work, but that didn't happen. So anyhow, all right. So the current asset section could look like this, right? All right. So you have your inventory, which is usually at end. That'll go there, right? And you have your accounts receivable. That's the allowance for doubtful debts or uncollectible accounts. Right? And then below that you have your net receivables. So net receivables. Right? Which is this minus that. After that, you could have your short-term investments. Actually, hold on. Sorry, no. Accrued revenue. Prepaid expenses. Right? Cash at bank and cash in hand. All right, so the question then becomes, where do we put these supplies or short-term investments, right? Now, supplies, because of their nature, like an inventory, you could actually put them on top of here. All right, what I'll do, inventory of. I'll put in a little bit of a yellow because it could potentially go there or a bit lower down depending on what the supply is of, right? So, for example, if it's like a large quantity of supplies that's going to be used up over, like, let's say 6 months, because some companies can sometimes they just buy in bulk. Like for me, it had a time I bought I think it was about 500 envelopes because it was like real cheap, and like I do use envelopes that often, like maybe once or twice a month. So like that lasted me for like 5 years and change. I still have envelopes in a bag up there from that same stock, right? And that was pre-pandemic, right? And what year are we in now? 2025. So we're talking about more than 5 years I had that bag for, right? So sometimes, yes, you can have supplies for a long time. I won't talk about materiality because that's a different conversation, right? Now, the short-term investments, that's the slightly more tricky one in terms of where to place it, right? Now, like I said, most times the investments, especially if they're short-term, are for like 3 to 6 months, but they could be for a year, right? If they are for a year, they could potentially go before inventory, all right? But sometimes, if they are for like 3 to 6 months or maybe 1 to 3 months, you can actually put them just above cash at bank. Right, so what I'll do is I'll put it here, right? Right, but I'll put it in like a green. All right, now they're not likely to ever give you that high level of detail in a CSEC PoA question, but it's not impossible. But long story short, don't let that panic you or paralyze you into indecision because you don't know where to put it. If you know it's a current asset, put it there, right? This order in which it is listed is, yes, order of liquidity. You know how many marks for that order? Maybe 1, probably a half. What happens if you put them out of order, but you have all the items that's supposed to go in there? You get the mark for each item you have there. So even if you were to, let's say, hold on, HS. All right, so let's say you started with it here, right? And you did like this, right? So you know stock's supposed to go first, and then you did this cash at hand, cash in bank. You put your doubtful debts there, you put receivables there, all kind of math. Let's say you did this, right? Once you have the current assets in the current asset section, you get a mark or a half mark at least for each of the items that you put there. And overall, the presentation gets another mark or a half mark, right? So don't let not knowing where to put an item paralyze you because of indecision. Put it somewhere in the correct section as the bottom line. All right. Okay, I'm gonna put this here. I'm gonna go on to the next page. I'm gonna do the current liabilities. Give you a kind of format to use, and I'm gonna do an example. Hopefully, we'll have time for you all to try one. Okay. Google Meet, just kindly give me a quick Genie chat if you guys are good with the current asset stuff, please, and thanks. If you need me to re-explain any particular one or all or anything in between, let me know. All right, so give me a Genie chat if you're good with that. If you need me to re-explain, give me a please and thanks. Oh, hey, I should have seen you back. You drop out. We're good to have you back. Hey, Amelia. All right, cool. All right, in class, people, you okay with the current asset stuff? Yeah? All right, lovely. Okay, so we're going to go to current liabilities. I'm just going to copy and paste the sheet because it's basically going to be along similar lines. So additional current liability. All right, so there's no analog or parallel for the provision for bad debts down there, right? In the current liabilities, we have accrued expenses and we have prepaid revenue, right? So this is any money or occurrences owed by you right? So if you owe money for electricity, insurance, wages and salaries, office expenses, motor expenses, whatever you owe money for except inventory, that goes under accrued expenses, right? Money owed by you, trade payables, right? Prepaid revenue, right? So this is when you receive payment for goods or services not yet delivered. Right? So sometimes it's called like advance payment, whatever the case is. So long story short, somebody's paid you before you've done what you're supposed to do. So now you have an obligation to do what you're supposed to do, which means either delivering your goods or delivering your services. But either way, you have something to deliver, some benefit to transfer, to render upon some other party. That's why it's a liability, right? Right. So we talked already about the current portion of a non-current loan, right? So we already kind of know what this is. It's a very basic definition, and we did it already, so we kind of know, what it is, right? Don't forget bank overdraft, right? So this is a short-term, on-demand. Right. It's prearranged on-demand. Which usually must be repaid within 1 year or less. All right. There was one other item that I told myself I would mention. I'm trying to remember what it is. This one is kind of already. Okay, so interest owing or dividends. Right. So interest is on loans and dividends is on shares. right? So I should really talk about these things separately, right? But as the name implies, once these things are owing, right? Now you could say that interest owing will come under accrued expenses, but usually you see interest is not like the other expenses in that it is the price you pay to borrow money, right? As opposed to like the cost of a good or a service that you haven't yet paid for, right? But at the end of the day, it is an expense, but it's worth showing separately. And dividends, right? So dividends is not an expense. Dividends are payments to shareholders who are owners of a company. And what has to happen before you pay them, you have to declare. So the board of directors, if anybody remembers that particular phrase, the board of directors has to state outright that, hey, we are going to pay our preference shareholders the preference dividend, and we are going to pay the shareholders whatever amount per share or whatever percentage of their shareholding as a dividend. From the instant the directors declare that dividend or that's made public, until those dividends are paid, they are owing from the company to the shareholders, right? So these are amounts owing to, so what's the name? So financial creditors in the case of and shareholders. Right, so I'm gonna just take a picture and send this in the chat. Now, the thing about the current liability section is that, as far as I know, and even my teacher, Mr. Cooper, knows, and he's been doing accounts longer than I have, there is no specific sequence in which the current liabilities have to be shown. Right? I mean, maybe teachers have given you all that just for the sake of simplicity because they don't want you all to try to figure out what to put where. So maybe they give you a guideline, but there's nothing official. It doesn't really conform to liquidity or permanence. Those more have to do with assets, right? But of course, the overall classifications of current or non-current can be, we could arrange according to permanence or liquidity using those. But the individual items within the current liability section, right? So that one, Nassim Yusuf, you get very old. Yep, well, that's happened. The thing about getting old is you're still alive. That's a blessing. All right, so current liabilities. Right, so we have accounts payable, accrued expenses, prepaid revenue, interest owing, dividends owing, bank overdraft, and the non-current portion, the current portion of non-current All right, cool. All right, Google Meet, just give me a quick G in the chat if you guys good with the current liability stuff. Now, please don't talk. All right, cool, lovely. Okay, cool. Okay, so folks, I think we have just enough time for me to do like an example with some of these things, but I wonder, boy, maybe I could kind of like get y'all to try it along with me. Okay, let's do that. All right, one second. Pull up this. Yeah, this was a words one. Okay. Okay, let's do this one. There's Jody Parks. It's 2022. Okay, cool. Hold on. Obviously, Christopher didn't do that. Yeah, I did it, but I just didn't label it. All right, so 2, 4, 6, 8. And for my Google Meet people, hold on 1 second. Let's see. It's the first one. Okay, cool. Up on the screen, but I'm also going to send you guys. Aisha, I'll get to you now, right? I'm not like big into them. You have to drive to drive them. I have some car fans in my class here. The cars. Hey guys, so what I want you all to do for me. All right, well, that's good. Right. So what I want you guys to do, so I'm going to draw a balance sheet. Right. I want you to do the net asset approach. Right. I'll also leave it up to you whether you want to show net working capital or not. Right. So what I actually would advise is to do net assets. For the assets first, you value the second and subtract. Let me tell you this. Yeah. So basically, you can kind of copy what they have for depreciation. No, we didn't cover it. Naming what standards, naming a car or naming a person. I forgot what we were For something called an edit. Oh, so today my stepson was talking about it. He likes the Porsche Taycan. And I was saying we saw Evo 10, a nice black Evo 10 on the road. Say again, sorry? First? As in here? Nope. Right. They added. They're not supposed to add depreciation. You're supposed to subtract. Right? So it's supposed to be 100 minus 25 is 75. Right? Yeah? Right. Yeah, it was pretty good. Right. So yeah, so Google Meet. So again, I know I put in a depreciation thing here and we didn't do it yet. So you're going to subtract. So one of the problems here was that they added depreciation. But depreciation is a decrease in value. So you're supposed to subtract going left to right. Right? So I want you to do the non-current assets, then the current assets. So I've seen inventory, I've seen account receivable. I'm not seeing any of the other stuff we did. So I kind of gave just like the easier one to do. Right? For the current liabilities, I'm seeing bank overdraft, I'm seeing accounts payable. And for non-current, I'm seeing mortgage, right? Oh. You're supposed to head up non-current assets, put those items. Current assets, put those items. Then give me a total of total assets. Then do non-current liabilities, current liabilities, give me a total. Yo. The depreciation? Yeah, yeah. The error they made here was they added the depreciation to the cost. But depreciation never supposed to be added to the cost. Always supposed to be subtracted. Two. What have we put up into 2022? So, it couldn't be before. All right, so what I'm going to do, guys, is I'm going to pull up the solution. Obviously not this one. Wrong item. One second. It's taking a little minute to open. I'm not sure why, to be honest with you. There you go, Jolly Pop. Okay. Let's take a look. Let's do our top and bottom split, shall we? Oops, that's a little too much. All right. Down here, we're going to zoom in as well so we can actually see what's going on. Okay, so we're going to start off with the non-current assets. So it's cost minus the depreciation. That's going to give us what we call the net book value, right? The value of the asset on our books, net of any depreciation. So motor vehicles, so 100 minus 25 is 75. So the error they made there was they added depreciation, right? And then they had office equipment, 92 minus 35 is 56. Now, we're supposed to show totals there, right? So that's what they didn't do here as well. Now, bank overdraft is not an asset. Neither is drawings, right? Accounts receivable, yes. Inventory, yes. Nothing else down here. All right, so current assets, inventory, account receivable. Now, let's show the net working capital. Sorry. So we need the overdraft and the accounts payable. You add those two things together, you get 26,880. You subtract it from this item here, and you get 50,820. Right. So this is the working capital approach. When you add these two things together, the 130,180 and the 50,820, we get 182,660. No, 620, sorry. Now there's also a mortgage of 75,908, which we have to subtract. In doing so, we'll get net assets of 106,712. And all we have to do is put the capital as that figure. Now, yes, there were other things I didn't show yet. Like, for example, there was the opening capital of 136,610. And then there was drawings of 18,998 and a net loss. So you're supposed to actually subtract those two things. So I'll just show you what this looks like. Next week, we'll kind of pick up with this, right? So yeah, so today, guys, I did start a bit late and things were a bit rushed. So it wasn't the best, and I do apologize for that. All right. But next week, scroll like that? Yeah. Yeah. But next week, Carnival is over and the traffic issue shouldn't be as bad. So what happened today shouldn't happen again. Shouldn't. Right? So we'll be at a slightly, no, I don't want to say a more relaxed pace, but because mock is not too long after that, and we technically only revised 2 things so far: income statements and balance sheets, right? Now, of course, anything else you want to revise is already up on my channel. If you can't find it, message me, and I could always send you a link directly. All right. What else I'm thinking to revise before mock? I'm hoping to revise some partnerships, maybe companies, and if time permits, bank recs, limited companies as well. Those tend to be the more popular topics. We did manufacturing recently enough, but we could always throw in 1 or 2 there with control accounts. And maybe we could take a look at some, I don't know if anybody here did budgets in school. Anybody did budgets? Cash budget, cash projections, production budget. Did you all do all those things?
She never went to classes. She said that she wanted to.
What did she teach them?
I would say.
No. Well, you're in a better place as far as I can see. So I'll cover those things in the Easter break, so you don't worry about
that. Chris.
Yeah.
So Cassie and no, not for mock, sorry, Spanish.
Right. Well, classes are like in the usual time in the evening, so they're not early on.
Oh, so it's gonna be the same time.
Yeah. Ever since 2018, when that problem started happening, 2017, as a matter of fact, when people started having to miss because they had to go in for mock or other teachers and other lessons had shifted their times. I don't know. Yeah, the actual ones, right. Anyhow, sorry, hold on. Yeah, so Google Meet, that's about it. Anybody doing maths with me, I'll see in about half an hour. We're doing Jan 2024. Today, we're starting it today, right? The rest of y'all, enjoy your carnival. Be safe, whatever you do. If you want any work to do, you can always message me. I'm not going out. I'm not sure what I will be doing. I'm pretty sure I know what my wife wants to do, where she wants to go. So I'll see if that happens, right? So if you all have any requests, send them in early, right? Anyhow, guys, I'll go on there for now. See you guys next time. Bye. Sorry? Hey, Naima. Thanks very much. That's very kind of you to say. Yeah, I didn't feel too amazing today because I was rushing and I was late. That's always good sometimes. I really appreciate your kind words. So thank you very much. But I ended the stream now because I had to go and grab some dinner before maths class. So if you're around,